To Europe now, and the markets have recovered a little after yesterday's battering. Alongside worries about the US and China, Europe's banks have to pay back almost €500 billion in loans to the ECB, Europe's central bank. Joining us now from London is David Buik from BGC Partners. David Buik, welcome to the programme.
Good evening.
Can you explain to us what is the significance of this European Central Bank deadline?
Absolutely. Well, I'll attempt to, in words of one syllable. Basically, about a year ago, the European Central Bank, under the presidency of Jean-Claude Trichet, negotiated a loan for a period of a year for all the European banks requiring temporary funding at 1% in the sum of £442 billion. Jean-Claude Trichet is of the opinion, as is the rest of the ECB, that the financial state of the banks is in marginally better state than it was a year ago, and therefore instead of offering terms of renewal for a year on the 442 billion, it decided to ask them to tender for what their individual requirements were this morning. Now, this was met with a certain amount of scepticism initially, just in case we got the wrong answer, because many of the European banks felt that the minimum amount that would be tendered for was 200 billion, and that was suggested by Commerzbank in Germany. Barclays banks thought it would be between 250 billion and 300 billion, and the Royal Bank of Scotland thought it would be over 300 billion. All we did know is if it was over 300 billion, the market had a serious problem. Why? Because the wholesale money markets, to all intents and purposes, are still moribund. They are very reluctant to lend each other money for periods of time.
So what happened, David, what actually happened? Because if that was the concern, and we're now sort of saying it's the liquidity stupid, what actually happened this morning?
Well, this morning they only tendered for 131.9 billion euros, which was way below any estimate. So that was taken as a very positive sign. But it's not the end of the story. So where does the story go on from here? Well, Chapter 2 is the stress tests. Now, they're due out next week. All the European banks have agreed independently to give stress tests to the European Central Bank, letting them know what the quality of their assets are, how much they're probably going to have to write off in terms of sovereign debt. But again, there's some problems with that, because Germany doesn't want to divulge exactly the status of each one of their banks. They just want the central bank to say, you've passed, you've passed, you've passed, or you haven't passed. Spanish banks want, of course, full disclosure. And so, again, the European Union and the ECB seem to be not singing from the same hymn sheet again, which is slightly disturbing.
Yes, I noticed that the Spanish finance minister was very concerned about the ECB's move. The French central bank governor says we'll make sure everything is going to go okay. But what is your instinct about how this is going to progress in the next few weeks? Because there is this constant talk now of a double-dip recession, isn't there?
There is the constant talk. I'm not wholly convinced about a double-dip recession. I am convinced about a plateauing out of growth during the course of the next 3 months, because regardless of whether the banks are in better shape or not, what is becoming very clear to us is consumer confidence has dropped, demand for banks to lend to big companies with great credit worthiness is not there, and also, whether we like it or not, sovereign debt and the quality is a real problem. And there are going to be significant write-downs.
Is the market then comfortable with the various austerity programmes that have been put through in Germany and London?
The lesser of two evils. We have to do it. It isn't an option not to deal with it. But we know there is going to be pain, and that pain is going to be unemployment. And this hiatus of time, whereby you transfer those people who are going to lose their job in the public sector, inevitably, whatever anybody or politician wants to dress it up at, and the time it takes to give them an environment and the incentive for people to employ them in the private sector. This isn't going to take a few weeks, it's going to take 3 years. And there's no question of any doubt about it, we are going to have a very painful process. Does that mean it's the end of a stock exchange rally? Or I don't think necessarily so, because I think we can have a buoyant stock market globally with unemployment. It's socially very unacceptable, but when people have been spending their time becoming mean and lean, and they're actually focusing on proper costs and running their business, there's no question that they can give adequate returns. There is a concern, of course, in the United States that the second quarter earnings may not be all that they were cracked up to be. We've had a number of companies, whether it's Nike or Bed Bath & Beyond and various other companies who've come back to the rostrum and saying, oh, not sure I can quite meet with these figures, and these are our new assessments. And that's given the market a little bit of a wobble. And today, of course, only about an hour ago, we had ADP employment figures, which is the private sector in the United States, and they were very disappointing, with only 13,000 jobs created when we were expecting 60,000 jobs, and this comes ahead of Friday's non-farm payrolls, which may see a loss of 75,000 jobs because we had that ridiculous temporary employment figure where the consensus for 2011.
All right, David Buik, thank you very much for joining us.
It's a pleasure.